Capital withdrawings. Explained simply. Now stop confusing business money with owner money. Here is something that surprises most people. Starting a business, mixing up capital and drawings doesn't look like a mistake at first. Your bank balance seems fine, your numbers add up, but your financial records are quietly lying to you. And when tax season comes, or when you need a loan, the truth shows up fast. Today we fix this completely, no jargon, no complexity, just clarity. Think about this. You open a business account, put in $10,000 from your savings, and 6 months later you take out $1,000 to pay your home rent. Feels like it's all your money, right? But in accounting, these are two completely different events, recorded differently, affecting your business differently. That's what capital and drawings are about. Let's break them down one at a time. Capital is what you bring to the table when you start or grow a business. Think of it like changing a battery. Without that initial charge, nothing runs. Once you invest it, that money legally belongs to the business, not to you personally anymore. But it does represent your ownership share. The more capital you put in, the bigger your stock in the business. In accounting, every capital contribution increases what we call owner's equity. Let's make this concrete. Sarah decides to open a bakery. She transfers $15,000 from her personal savings into the business bank account. The moment she does that, it's no longer Sarah's money, it's the bakery's money. Sarah's personal net worth goes down by $15,000, but her ownership in the bakery goes up by $15,000. In the accounting book, we debit cash and credit capital. Simple, clean, and accurate. Now flip it. Drawings happen when the owner pulls money out of the business for personal reasons. Groceries, rent, a holiday, anything outside the business. Here's the critical point. Drawings are not a business expense. Buying a new oven for the bakery is an expense. Taking $500 to pay your electricity bill at home is a drawing. The business didn't benefit, you did. That's why it gets its own separate record. Same bakery, 3 months later, Sarah needs $2,000 to pay her apartment rent. She takes it from the bakery account. Now watch what happens. The bakery has $2,000 in cash, and Sarah's equity in the bakery also drops by $2,000. The business didn't spend on operations. Sarah withdrawn her own share. That withdrawal is a drawing. If Sarah accidentally recorded this as a business expense, her profit figures would be wrong, and so would her fixes. Her profit figures would be wrong, and so would her taxes. This is the slide to screenshot. Capital and drawings are opposites. Capital is money flowing into the business. It strengthens your stake. Drawings are money flowing out. They reduce it. Once one builds the business up, the other takes from it. Neither is good or bad. Both are normal, but they must be recorded separately every single time. If you remember this table alone, you are already ahead of most small business owners. Here is where most beginners go wrong. They treat drawings like any other expense, salaries, rent, supplies. But if Sarah records her $2,000 rent withdrawal as a business expense, the bakery's profit on paper shrinks by $2,000. Now her financial statements are inaccurate. If she applies for a business loan or files taxes, what wrong numbers follows her everywhere. This fix is simple. Just use the drawings account. One small habit that protects your entire record. Once you track capital and drawings correctly, something powerful happens. You can actually see whether your business is growing or whether you have just been moving money around. A business that looks profitable might actually have an owner drawing too much. A business that looks weak might just have had a large capital injection. Proper separation gives you the honest picture, and that honest picture is what smart decisions are built on. Let's wrap up. Capital is the money you invest into your business. It increases your ownership. Drawings is the money you take out for personal use. It decreases your ownership. Never mix them with expenses. That single habit keeps your books clean and decisions sharp. Now here is your quiz. Drop your answer in the comments. If an owner buys a laptop for business use, is that capital, drawings, or neither? Think about it. I will reply to the first 10 answers. If this video helped you, subscribe. Next, we are covering assets or with liabilities in the same simple style. Thank you very much.